The long wave. Lights up on a quiet room. A handful of chairs. A chalkboard with a few faint price levels drawn. The speaker steps forward, hands loose at his sides, eyes steady. You want a secret. Everyone does. They come to the market the way a man comes to a fortune teller, hungry for prophecy, desperate for a glimpse of tomorrow's prices today. They want a code, a machine, a talisman. I waited a long time for one too. Never found it. And after enough time losing money, I realized the only honest thing on the street is the tape. It speaks in plain numbers, no adjectives, no sugar, and it tells you everything you need to know, if you can quiet your own chatter long enough to hear it. That's the real trick. Not intelligence, not information. Quiet. You think the market is complex. It is on the surface, like watching a storm on a choppy sea. But underneath, the same old current moves fear and greed, pulling now one way, now the other. Century after century, names change, tickers change, headlines change, but the human animal doesn't. If you doubt that, go read the old accounts 1919, 1929, 1987, 2000, 2008, 2020. Different costumes, same play. The crowd ran too hot, then froze. Somewhere in that back and forth, men either grew rich or went broke, depending on whether they could stand still long enough to watch the tide instead of the ripples at their feet. Let me ask you a question you probably avoid. Can you sit still? Not just in a chair, I mean in your mind. Can you sit without needing the market to move just because you're itching to act? Most traders can't. They chase ticks the way a cat chases a laser pointer. A nickel here, a dime there, and an account that dribbles out in commissions and mistakes. They're studying tree bark while the forest burns behind them. They're alive with motion and dead to the signal. The market punishes busyness. It rewards patience. That's a law as old as the tape. If you want the difference between a gambler and a speculator, I'll tell you. The gambler bets on noise. The speculator waits for music. Noise is the little jiggles, the nonsense of the day, the rumor, the headline that's already stale by noon. Music is the long swing. It doesn't play every hour. Sometimes it's silent for weeks. Then one day you hear a bar or two. A stock refuses to go down on bad news. The market tries to rally and can't. Volume starts to build in quiet places. That's the start of the wave. Most men are too impatient to notice. They want the chorus before the intro. By the time they hear the chorus, the move is half over and the easy money is gone. You ask about edges. Not permanent ones, they don't exist, but edges that will last long enough to build a fortune if you've got the nerve and the patience. Here's one. Notice strength when there ought to be weakness, and weakness when there ought to be strength. The market is a simple judge, a heavy hammer that hits anything out of line. When it fails to hit, that's your clue. A company misses earnings and the stock pops higher. The crowd squints and shrugs. Must be some short covering, they say, and go back to their coffee. You, on the other hand, lean forward. You watch how it acts into the close, how it behaves the next morning, how dips are bought and rallies extend. If you see that behavior repeat shallow pullbacks, higher lows, volume arriving down low and vanishing on the downswings, you're looking at accumulation. You don't need a press release to confirm it. The press will confirm it after it's too late. I learned that lesson in the bucket shops. No research department, no management calls, no scoops, just the tape. I'd watch a stock knock its head on a number, say 53 or 4 times. Every time, it backed away. And every time, it backed away a little less. Then, one day, it nudged through and kept walking like the door had always been unlocked. It wasn't magic. It was buyers who'd finally absorbed the sellers at that level. The tape said, "The weight has shifted." That's a tide change. If you can train your eye to see the weight of money tilt, you'll stop arguing with headlines. and start listening to price. Price is the judge, the jury, and the executioner. It does not answer to your opinion. Your biggest enemy, if you haven't learned already, is your own ego. The ego wants to predict. It wants to be a prophet. It wants to say, "I called the bottom," and collect a round of applause. The market pays no applause. It pays dollars to people who can look at a chart, feel nothing and say, "This is going up," or "This is going down," and then wait like a stone until the wave proves them wrong or proves them right. You don't need to be smart to do that. You need character. Character is three things in this business: discipline, humility, and endurance. Intelligence is fine. Education is fine. But if you don't have those three, you'll find a way to hand your money to someone who does. Discipline first. Every man in this room knows the rule. Cut losses quickly. Let profits run. And yet almost no one does it. They'll write it on a sticky note. They'll tattoo it on their forearm. Then the first time a position goes against them, they start explaining. It'll come back. The market misunderstood. It's just a shakeout. If your rule depends on how you feel, it isn't a rule. It's a suggestion. Suggestions don't survive contact with fear. Discipline means you sell when the tape says you're wrong, not when you feel ready to admit it, not when your pride has had time to grieve. When the price invalidates your premise, you're out. Full stop. No story. The market doesn't read your notes. It reads your orders. Humility next. Humility is the hardest for clever men. The street humbles everyone eventually, but the wise humble themselves daily. That means you don't fight the tape, you follow it. If it tells you you're wrong, you step aside. You don't throw rocks at a freight train because you'd like it to reverse. You get off the tracks. The humble trader doesn't need to be the smartest in the room. He just needs to be the quickest to say, "I'm wrong," and take the small loss instead of the ruinous one. That speed, by the way, is money in your pocket. Every slow admission costs. Endurance last. Most fortunes in speculation are made waiting, not trading. Waiting to get in when the wave is just forming. Waiting to hold while it runs and shakes and rattles your nerves. Waiting to get out when the long swing has clearly finished. Waiting through dull periods when nothing lines up and doing nothing would be wisdom if it weren't so boring. That boredom is expensive for most. They nibble because they can't stand the quiet. They trade because action feels like progress. They chip away at their capital and their confidence until nothing is left to deploy when the real moment arrives. Endurance is the patient refusal to waste bullets. Now let me give you something specific. You're owed at least that for listening to philosophy. Let's talk about the anatomy of a wave. Waves don't announce themselves with trumpets. First, you see a period of quiet price in a narrow range, volatility compressed. If you listen closely, you'll hear two stories. The crowd says, "Nothing's happening." The tape says, "Energy is building." One day, the price pushes to the top of that range. It pauses. Maybe it pokes through, then stalls and falls back. Watch the pullback. Is it violent, on heavy volume, with ugly closes? That's failure. Or is it mild 2 or 3 days down on lighter volume, closes mid-range or better, and buyers show up at prior support? That's your tell. That's the market saying, there are hands beneath this price. Then comes the second push. It clears the level and holds above it. Now check the character of the action. Are dips getting bought faster than before? Are former resistance levels acting like support? Do you see expanding volume on advances and contracting volume on declines? Are the strongest peers moving in the same direction? Is the general tape supportive? Or is this thing running uphill alone? Strength that stands alone can be admirable and dangerous. Strength that sings in chorus with its group and the market is something else. You don't need 100 confirmations. You need enough. Enough to act. The crowd waits for the newspaper headline because they want permission. By the time they get it, you're in profit and they're late to the party. Now the dull part. Sit. Sitting is the one act that separates operators from noise chasers. The market will test you with shakeouts, pullbacks, overnight gaps, rumors, downgrades, misquotes, and every manner of nonsense. Your job is to sit if the wave is intact and cut if it's broken. What tells you it's intact? Higher highs and higher lows in an uptrend, shrinking reactions, support holding where it should, leading peers confirming, no distribution days stacking up in the broader indexes. What tells you it's broken? Lower highs, failed breakouts that don't recover, support that flips to resistance and stays that way, heavy selling into strength, the tape suddenly rewarding bad behavior from the stock. You don't sit out of stubbornness. You sit out of alignment with the trend. The day that alignment breaks, you stop sitting and start exiting. But what about getting the bottom? What about selling the top? That's for storytellers and drunks to brag over. The money's in the middle. Take the fat part of the steak. Let someone else fight over the sizzle. You'll live longer. I never built a fortune by buying at the exact bottom. I built it by buying when the market already agreed with me and selling when the market started to disagree, and not a moment later. The rest is vanity. You know, I can tell how someone will fare in this business by how they behave when nothing is happening. The professionals conserve energy. They do their homework. They build watch lists. They note which stocks refuse to go down when the market is soft, and which ones refuse to go up when the market is strong. They pay attention to the quality of reactions. They notice if a stock offers second chances to buy weakness or if it makes you chase. They get interested in the former and suspicious of the latter. They write things down, levels, characters, quirks, so they're ready when the tape rings the bell. The amateurs, in the same stretch, flip coins for small stakes and call it practice. The only thing they practice is how to lose small amounts frequently until the habit becomes a reflex. When the real move comes, they're too fatigued or too broke to step in size. Here's something else. You don't need to trade all the time. You need to be right at the right times. 10 trades a year can make you rich, if they're the right 10 and you size them honestly. 100 a week can make you broke if they're driven by boredom. A good operator knows the difference between absence of opportunity and absence of activity. One is the market's condition. The other is your condition. If you mistake your need to feel busy for the market offering a trade, you will slowly burn your capital. No system can save you from that. Let's talk about risk, because nothing ends a career faster than forgetting it. Risk is not how far a stock might go. It's how far you will let it go against you. Risk is always your decision. People talk about volatility as if it's weather. It isn't weather. It's waves. You don't control the waves, but you control whether you're standing knee-deep when they crash. If you can't define your exit when you enter, you're not trading, you're hoping. Hope is a wonderful emotion in church, a ruinous one in the market. Draw the line where the premise is wrong. Trade smaller if the line is far. Trade larger if it's close, and the odds are good. Never let a position grow larger because it's moving against you. That's how men vanish. You might be wondering about news. What about macro? What about the Fed? What about earnings? Fine, listen. But remember, the tape will tell you the impact. It always has the last word. If the Fed speaks and the market rallies for an hour and then sells all day on rising volume, the message isn't in the speech. It's in the selling. If earnings beat and a leader plunges, don't defend your model. Defend your capital. The tape is the final judge. The more you outsource judgment to pundits, the later you'll be to the real move. The street is littered with men who were right about the narrative and wrong about the price. The price is where you settle your bets. Ego ruins more traders than bad luck. Ego wants to be right, to be praised, to be clever. It will have you averaging down because you know you're right. It will have you holding a loser because you know the market is wrong. It will have you selling a winner because you're afraid to look greedy in front of your own mirror. If you want to keep your account, declare war on your ego. Replace the question, "Am I right?" with, "What is the tape doing?" Replace, "Will they praise me?" with, "Will this entry age well?" Replace, "Do I feel comfortable?" with, "Is my risk defined and my plan clear?" If you can do that for a year, you'll feel like a different man. If you can do it for 5, you won't recognize the amateur you used to be. I had a student once, bright, hungry, fast with numbers. He'd analyze a company until the sun went down. Eventually he'd convince himself the stock had to go his way. He'd buy. The tape would disagree. He'd hold. "It's just irrational," he'd say, as if calling the market irrational made it safer to ignore. By the time the stock visited his mental stop, he'd moved the stop 3 times. Eventually, he sold right where the smart money stepped in to buy his shares at a discount. He wasn't unlucky. He was proud. He was arguing with the only honest referee in the arena. When he learned to stop arguing, to cut as soon as the premise broke, and to re-enter when the market reclaimed the level, his losses got smaller and his winners got bigger. Nothing mystical, just discipline. Discipline isn't something you decide once. It's a practice you repeat under pressure. Every trade is a test. Every pullback in a winning position is a test. Every rumor that hits your stock is a test. Pass enough tests and you build a habit. Build the habit and you build a career. Fail the tests and you build a record of excuses. The market doesn't accept excuses. It accepts orders. Now, about size. You make money with size, there's no sense pretending otherwise. But you survive by earning the right to use it. The mistake amateurs make is to size up when they're emotionally confident, not when the market is statistically favorable. Emotions are lagging indicators. You feel brave after a run of winners, just in time to get sloppy. Professionals size up when the setups are clean, when breadth aligns, when leadership is obvious, when the character of the tape is firm, when their edge is present, not because they're bored, not because they're overdue, because the conditions merit it. And if the conditions don't, they stand down. The hardest act is doing nothing after a big win. The second hardest is doing nothing after a big loss. In both cases, doing nothing is usually correct. You want habits? I'll give you some you can take home. Before the open, write your levels. Where is the line that proves you wrong? Where is the level that proves the stock? Not vague zones numbers. If you don't have them, you don't have a plan. During the day, watch reaction quality. Strong stocks pulled back on light volume and close better than they open. Weak stocks rally on fumes and close worse than they open. The close is a jury verdict. A string of strong closes means accumulation. A string of weak closes means distribution. Keep a small book of tells. Stocks that refuse to break on bad news, indices that can't rally on good news, groups that lead turns. When the market changes character, your tells will whisper first. Journal your exits, not just your entries. Everyone logs the reason to buy. The pros log the reason to sell. Did you exit because the premise broke? Or because you felt nervous? Did you take profits into strength? Or did you wait for a reversal to force you? Over months, you'll see your mind on paper. You can't fix what you won't face. Limit predictions to conditional statements. If X breaks and holds with Y volume, I'll do Z. That's as far as your crystal ball should go. The rest is fantasy. Protect your mental capital. If you've been wrong 3 times in a row in the same name or the same setup, step back. The tape is telling you something about your read. Don't pay tuition you can't afford. Let's talk about exits, because people like to romanticize entries. Entries are exciting. Exits are character. There are only 3 honorable reasons to sell. 1. Your premise is invalidated. 2. Your target, your plan, is complete. 3. Your trail, your winner, has begun to misbehave against the trend. Anything else is an emotion wearing a mask. Because the profit and loss looks large and you're afraid to give it back, that's fear, not strategy. If you hold because you want a round number, that's pride, not process. Design your exit when you're calm and obey it when you're tempted. If you can't obey it, reduce your size until you can. You ask, how do I know when the wave is over? You don't. Not precisely. You learn to read late-stage behavior. In an uptrend, the late stage often shows as acceleration-wide bars, gap and run days, euphoric volume and then exhaustion spikes that fail, blow-off tops, leaders diverging, distribution in the indices. You don't short the first sign of joy. You watch for the character change. When former support breaks and stays broken, when leaders fail to make new highs with the index, when rallies are sold hard and quickly, you admit the wave is aged. You scale out on the way up. If you like nothing wrong with paying yourself and you keep a last piece with a trail until the market takes you out. Selling the last piece is always difficult. That's why you automate as much as you can. When the line breaks, you're gone. No heroics. Boredom is a killer. So is loneliness. This work is lonely. There is no cheering section for the early buyer of an unloved stock or the early seller of a darling. Your own mind will berate you for looking foolish. Your friends will tell you you're wrong. The newscaster will sound certain. The tape will ignore them all. If you need permission from the crowd, speculation will starve you. If you need to be liked, it will humiliate you. You must cultivate indifference to social confirmation, not arrogance, indifference. Humility before the market, indifference to the mob. That combination is rare, but you can learn it. Risk of ruin is real. One lapse can undo months of work. That's why I talk about character more than indicators. Indicators won't save you when you feel the urge to double down on a loser just this once. Character will. A rule is a fence you build in the cool morning, so you don't run off the cliff in the afternoon heat. Keep your fences. They'll keep you. You'll hear talk about systems. Mechanical, discretionary, hybrid, algorithmic. They can all work. They can all fail. The engine isn't the problem. The driver is. If you can't take a small loss, no system will help you. If you can't sit with a winner, no algorithm will fix your nerves. If you can't follow your own signals, complexity is camouflage for cowardice. Start simple. Trend, level, volume, relative strength. Add nuance only when you've mastered obedience. Observation without ego is a muscle. Train it. Spend entire sessions watching a single leader across markets rise and fall. Note when it strengthens on a weak tape. Note when it weakens on a strong tape. That divergence is the story. The tape will give you these stories every day if you stop asking it to confirm your opinions and start asking it to tell you what's true. The market will always tempt you to violate your rules when it matters most. It will lull you in dull times. It will jolt you in fast times. It will present a parade of distractions, a pundit calling doom, a guru calling glory, a friend whispering a tip. If you build your playbook on behavior and adhere to it, these distractions become background noise. Your decisions become straightforward, aligned or not aligned, risk defined or not, premise intact or broken. Let me strip this to essentials you can carry anywhere. Trade only when your setup is present. A setup is a condition of behavior, not a hunch. Define your risk in price, in size, and in total account terms before you click. Enter where the market proves your idea, not where your ego wants credit for calling the exact turn. Sit when the wave is working. Ignore the itch. It isn't hunger, it's habit. Exit when the premise breaks or the plan completes. No speeches. Review every week. Numbers don't lie. Your stories do. That's it. That's the boring, grinding truth. Observation, patience, discipline, over and over again. It will never be glamorous. It will never be easy. It will often be lonely. And it will be worth more than any tip, any rumor, any miracle indicator, because it's durable. Systems change. Markets evolve. Human nature repeats. If you train yourself to see behavior, to spot the tells of accumulation and distribution, to feel the weight of money in the way price responds to pressure, you will always have a way to understand what's happening, even when the industry has invented new names for old mistakes. Let me tell you the most expensive sentence I ever spoke. I'll give it one more point. That was pride negotiating with fear. Pride said I couldn't be wrong. Fear said I couldn't take the pain. The tape said nothing. It just kept printing lower. When I finally sold, the loss was twice what it needed to be, and the lesson was stamped on my forehead. Don't negotiate with yourself in a burning house. If you write a rule in the cold, obey it in the heat. And the best sentence I ever learned to say? I'm wrong. Say it quickly. Say it cheaply. The market will forgive your errors if you do. It will not forgive your denial. Do you need a mantra? Here's one. See, wait, act, sit, exit, review, then repeat. That rhythm is the heartbeat of a speculator. See means observe without bias. Wait means stand still until the evidence is enough. Act means step in with defined risk. Sit means endure the noise. Exit means obey your plan. Review means refine your eye. 6 steps. A lifetime of work. I'll finish with the question I asked you at the start. Can you sit still long enough to see it unfold? Not just a stock's move, but your own development. Can you sit with boredom while you practice? Can you sit with discomfort while you learn to cut losses? Can you sit with success without getting drunk on it? The market will test you on all 3. If you can endure that, you won't need anybody's secret. You'll have a method no one can take from you, because it's written into the way you see. When the tide comes in, you'll notice the first subtle swells long before the shore is crowded. You'll take your position while the band is still tuning. When the music swells and the crowd surges, you'll already be dancing. And when the song is ending and the others are just arriving, you'll tip your hat, step aside, count your winnings, and wait for the next wave, calm, patient, quiet. That's the work. That's the way. That's all there is. And it's enough. The speaker pauses. Chalk squeaks as he writes 6 words on the board. See, wait, act, sit, exit, review. He sets down the chalk, looks around the room, and offers a thin smile. Go on then. The tape is open. The waves are out there. Learn to see them. And when you do, have the character to ride them. No noise, no pride, no rush. Just the market's music, and your patience to hear it.